Well, hello and welcome to this very special webinar of investors in the Switzer Dividend Growth Fund. Of course, you know who I am. I'm Peter Switzer, and joining me is Paul Rickard.
Hi, Peter.
Now, Paul is actually 1.5 metres away, so the Prime Minister will be very happy about that we're actually doing as we're told. And a long way away via technology is our portfolio manager, Shawn Burns. Shawn, thanks for joining us.
Pleasure, Peter.
Okay, before we start looking at how we're investing, and particularly you, Shawn, in a coronavirus crisis, let's just look at the last couple of days. Now, Paul, you and I have been watching the screens and hardly getting any sleep. What we're seeing is actually a lot better than we expected.
Yeah, we're seeing, I think, in an Australian context, three things, Peter. And we'll probably should talk about what's in the global context. But in Australian context, we're seeing the government throw the kitchen sink, literally, of the problem. That third stimulus package.
A very expensive kitchen
sink. Of $130 billion. Put that in context, the first one of just 2.5 weeks ago was $16.9 billion. Second one was $66 billion, and the third one's $130 billion. So
huge.
It shows you an escalation, almost geometric progression, and the market's got excited about it. Because what that means, what we're going to see, Peter, is a lot of employers are going to rehire people they've laid off, right? Not only will people keep staff, but a lot of the companies were going to rehire people for two reasons. One is they get more money.
Yep.
The $1,500 per fortnight is more under this package than they get from the job seeker payments, the old New Start payment, even with the coronavirus allowance. And secondly, employers want to stay in touch with their employees because they know they're going to have to rehire at some stage.
Yep.
So if you can give the employee more, plus you can stay in touch, why wouldn't you do it? So that's where the people are going to go. That's going to be good for the economy. It's going to be good for a lot of our cyclical economies, companies that rely on domestic spending. So that's number one. Number two, we've started to see, I think, maybe some more encouraging statistics about the spread of the virus, particularly in Europe. I think New York's still the hottest.
Australia as well.
Australia as well. But I mean, I think in the global market sense, it's really about what's going on in the US. And I think it's too early to call the stats better in the US, but maybe just people are taking a bit of encouragement from elsewhere.
Yeah. And remember, Donald Trump thinks that the numbers will peak in mid-April. He's extended social distancing and all those sort of measures until the end of April. You know, we know Donald can exaggerate, but it's a big gamble for him, isn't it? If he gets this wrong, they will remember it come the election.
I won't say it's his political history. He'll be written off. A lot of people have already called that, but it is a big gamble. I think the third thing, I think last night's announcement from Johnson & Johnson about that they're ready to potentially do some sort of effectively a stage 3 testing in September. That's a clinical trial involving people with virus. I think that's a big announcement because all the talk about a vaccine has been sort of 12 to 18 months away. This possibly puts a vaccine sort of out there about 12 months away. You know, assuming the trial works. So I think that's pretty big for markets everywhere. And when a company of that size is saying it comes out with a statement like that, this is not a two-bob sort of pharmaceutical company saying we've discovered the answer. This is arguably the biggest health company in the world saying it's ready to start doing a trial.
So in a sense, and I think this is what people must understand, is that, and everyone was thrown by the fact the market fell so viciously. But when it did fall so viciously, it was because the magnitude of the problems in China and then in Italy was seen to be a threat to all economies. And the market then had to sell off because they didn't know what central banks were going to do to help the money markets. And ultimately the stock market. They didn't know what governments were going to do in terms of stimulus packages. And the responses so far have been so good, I think it's put a safety net underneath the market. And that's why we've seen our market has crept back about 15%. I think Switz itself has crept back about 21% off its low. And that's because there is more certainty offsetting the uncertainty. There's still uncertainty out there, and the virus numbers are going to be critically important. But at least we're moving in the right direction. And for those people who have stuck by their portfolios, I think it's actually going to prove to be the right thing. All right, anything else, Paul?
Well, I don't think we're saying the bear market is over necessarily, Peter, but I do think we may have seen a floor, as you said, and markets have certainly been buoyed by those things happening. So, long time to go, but we're now talking about, the V-shape or U-shape style recovery. But the fact the market's talking about that is one of the reasons why it's up.
Yeah, Shawn, what's your take on what we've seen over the past week or so?
Oh, I suppose the area I've been focusing most on, Peter, is the high yield credit markets, and why that is because that's basically the canary in the coal mine. That's the area where sort of riskier companies, can they borrow, can they get money, can they get liquidity, can they pay their creditors and keep the liquidity flowing through the system. And it looked pretty diabolical up until probably about a week ago, and then there was a big turn. And that coincided with the central banks and the governments coming out and throwing everything they could at it. And it's important that works, that keeps that market and liquidity flowing at that pointy end of the economy. So that's the most encouraging sign I've seen for quite a while.
I must tell everybody out there that it was a rare moment, because Shawn was so excited he actually sent me an email saying, I'm excited. And if you ever think that Shawn Burns is anything like Big Kev, he's not one little bit. His email indicated to me that was an interesting point in both our lives. All right, let's go to these talking points. Shawn, how are you positioning the portfolio amid all this volatility?
I think that Switzer is a dividend fund. We want to try and buy those companies and hold those companies that pay dividends. We also hold what we think are the best companies in Australia. A selection of blue chip companies across the board, a diverse range of companies, and we're also fully invested long only funds. So at the moment we hold 3-4% cash. And the reason we're holding that cash is that we just want to hold a bit in reserve, because we think there may be some companies that need financing over the next between now and the end of the year, capital raisings, and we want to be prepared to not be diluted and participate in those where we think they're very attractive. But I think that we hold it is a quality company, a quality portfolio with quality companies, and we think that those are best place to ride out whatever's thrown at us.
I think it's important, Shawn, just to reiterate that point about Switzer being a long-only fund. There are funds out there who actively manage the allocation to different assets. In other words, they're in shares one day and they get bearish and they go to all the cash, and they might, but that's not what Switzer is designed to do. It's designed to provide access to shares with great long-term income, and that's why it's essentially the cash allocation is always going to be very small. That's set out deliberately set out in its design. So I know there's been a couple of questions about that, Peter, and that's why I just wanted to reiterate that point. It's very much the design of the fund itself.
This is a tough question, but you have to answer it, Shawn. What's your outlook for Switzer in the months ahead?
I'll split that into two buckets, Peter. The first one is where we are now. As I said, I sort of went positive on marks probably about a week ago because of those credit markets. I think that we're seeing like a bottoming, in a major long-term bottoming. How long that goes, how many ups and downs we get between now and the final rally, no one really knows. I mean, there's still plenty of bad news to circumvent that. But I think from a capital point of view, capital share prices, I think, and depending on your time frame of investing, I mean, some of these people who are talking have a very short time frame, like one day. But if you have a time frame of years, now is a good time to be buying blue chip shares. The part that concerns me, I think, is what is happening with dividends over between now and the end of the year. We're seeing a lot of companies under stress in terms of their revenues are drying up, and they're still running their businesses. Have cut costs, but they slowly accumulating debt. The banks look like they're basically on board, and all those companies will run debt up during this process. Under that scenario, it's hard to see a lot of companies going out of the way to pay big dividends. So I'm a little bit, I'm cautious on what we will see over the immediate period. I think boards will err to conservativeness and pay out something, but probably you're not going to get many positive surprises on dividends over the next result season, I suspect.
Maybe Woolworths can afford to because they're doing
I think
very well.
Coles, Woolworths, the banks, Telstra, they will pay out something. Some of the others, may kick the can down the road a bit.
Well, you've actually written a piece on dividends. What's your view on dividends?
Yeah, we always said, I think, Peter, the dividends are going to be a lot lower this year. That was before the virus.
Yeah, you did.
And it's just worth reiterating a couple of things. The last year was exceptional. I won't get political, but a lot of it was due to the election in May last year.
Yeah, Bill Shorten scared a lot of people with his franking credits policy.
And companies, as a result, did a couple of things. One is that a lot of companies pay special dividends to use up franking credits. Secondly, a lot of companies had off-market share buybacks, which our fund actively participates in because you get a huge franking credit, which is very effective, tax efficient for low-rate taxpayers. And thirdly, a lot of companies brought forward the payment of dividends to the financial year of 18-19. So the last year was an exceptional year. You were never going to get that repeated. That's the first point. Secondly, the market. We're now in a situation where we've had a virus, which is, for many companies, is going to reduce revenue and reduce earnings.
Yep.
And I think Shawn's right. Companies are going to err on the conservative side. So some have cancelled their dividend. Only a handful have cancelled their dividend, but a few have cancelled their dividend that was going to be paid in early March, late March and early April. We're now sort of through that. The next dividend season, we'll see the major banks in May. But I think we're going to see conservatism amongst some of the smaller cap companies, those with higher gearing levels. I think the big companies will largely be right. But if you're a director of a company, and your revenue situation is still a bit uncertain, you're going to err on the conservative side. So we're going to see in this financial year, dividends are going to be lower than they were last year, simply because A, it was an exceptional year last year, but B, we've now got the impact of the virus as Shawn set out. We're certainly not going to see any off-market buybacks this year, Peter. So, all those sort of things have gone. And so just as interest rates have come down, we're going to have to get used to lower dividend yields.
Yeah, and I guess we always make the point that if you look at the stock market, it tends to go up around 10% per annum over a decade, and half of that is dividends. It's 5%. Now, we had such a great year last year. Probably when you add this poor year coming up, we're still probably averaging around 5%. What do you reckon, Shawn?
Yeah, I think so. I think that it looks like an air pocket coming up here in dividends, and it's a very abnormal situation. When that normalises, I think the dividends will come back, but we have to get through that, between now and the end of the year, probably.
Thank God no one's changing the franking credits rule. All right, so how are the stocks in the portfolio actually performing, Shawn? I guess some people are wondering, do you have any stocks that are really badly exposed to the travel industry?
Travel, probably second order effects, things like the Star City Casino is like, obviously that casino shut down, so and Sydney Airport. So we're in a strange world where some of these fortress type assets and top quality shopping centres, airports, casinos, even toll roads, like getting the traffic down. So some of those like that you'd ordinarily think would go through a recession reasonably well have been by government directive have been closed down. So those will be under pressure. We don't think we've got, I could probably count maybe at this stage, maybe 3 or 4 who would need capital out of over 40 companies in the fund. So it's, as I said, we are skewed towards quality. So and that's why we keep that 4% in case they do need that, that we are there and we will participate if we think it's attractive, Peter.
Okay. Paul, is there any question you'd like to ask Shawn just while you've been listening?
Yeah, look, essentially, always focus on the ones that have been impacted. There've been a couple of winning stocks though too, and stocks that have done pretty well in this whole pullback. Shawn, you want to just comment on the ones in your portfolio done on a relative basis pretty well?
Yeah, obviously the supermarkets have, it's just played into their essential services. Everyone can see that their turnover is high. We've got about 5% of the portfolio in Woolies and Coles combined, and we also have a reasonable position in Wesfarmers as well. So those, I expect those stocks to pay dividends. They were good. Telstra is. This again is played in the Telstra's hands. We hold a position in Telstra. Everyone's staying at home using their computers, using the network, etc. And when you look at, we had a call with Telstra last week. When you look at their receivables, it's spread out. They've got a bit of small business, but mainly it's a lot of retail guys who will be paying to keep their phones and their networks going. That will probably be one thing they will keep going. So there's a sort of and also iron ore prices through all of this have been, been remarkably strong. And we own a good big position in BHP, and we also own Fortescue. We expect those to both pay dividends coming up in when we get to August. So it's not all bad news. That's why the reason we hold a diversified portfolio. Some stocks are actually travelling through this reasonably well.
And it does actually really highlight that lesson about diversification, because if you sort of said to me, you're going to go to this sort of type of collapse, and whole economies are going to shut down globally, you would have thought that iron ore would be smashed, right? Iron ore has held up remarkably well above $80. Some of the other commodities have done, like oil, but even copper have done pretty badly. But iron ore has done really well. So in a relative sense, the BHPs and Fortescues are only down a little bit, and it's not always what you expect. So it's
and I will make the point to anyone who's out there, who's a loyal investors, that I actually created this after listening to Graham Richardson on my TV show, because Graham was actually saying that he was doing very well with his. I asked him about his self-managed super fund, and he actually said, "I'm doing really well. I've got the 4 banks and Telstra," and I said to him, it's good now, but that's a really risky allocation. And I said, you should be more diversified. And that's realised a lot of people were doing exactly what Graham was doing. Now, for a while, that was before this crash, it wasn't bad. The banks were paying pretty good dividends and whatever. But I'd like to compare us against the 4 banks and Telstra when it comes to dividends. I think we do pretty well, Shawn, wouldn't you?
Oh, I think so. Yeah, I think that's correct, Peter. I think diversifying across several sectors and companies, etc., is well, that's what this diversification is about. You don't diversify to buy bad companies, you diversify to buy good companies in different areas. So if something unforeseen happens like this, you have an offset.
Okay, let's go to some of the investor questions we've got here already. First one, Shawn, pressure's on you. Why is the dividend just announced so low?
Yeah, we had a bit of a look at that. It basically comes down to, so this is before Corona, so the last dividend announced, and 2 reasons for that is, one is the BHP buyback was in last year. That was huge. That is obviously not this year, and also just a timing difference in terms of when dividends are being received. So they're in different quarters. The underlying, I think the underlying dividend was down 3% year on year, and there's a couple of, that's not much, but it's, I think, like someone like Woodside paid a special last year, etc. So, but the underlying dividends are sound and stable up until March. They're probably landing different quarters, so you're getting a bit of volatility there, and also that BHP special was huge.
Yeah, and just to just to add a bit of colour to that, the BHP, the off-market buyback, of course, is the payment you actually get is, most of that is actually a dividend payment, and so that's why you get that in one quarter, which happened in 2019. It's not repeated in 2020. That makes a huge difference. And as a fund, that one of the designs of the Switzer fund was to make it as effective as we could for low-rate taxpayers. We actually go out of our way to accept those off-market buybacks, because they are particularly tax effective, give you a much bigger franking credit that we can distribute. So one quarter you get one quarter you don't. That can have a huge impact on the actual dividend number.
Yeah. So the effects. You're going, Shawn.
Sorry, just as a final on that BHP. When you participate in those, you sell them below market because you're getting a fully franked dividend. We actually covered that BHP back at those prices now, so we had to wait a while, but we've managed to buy those BHP at the same price as what we sold them into the buyback. So that's a good outcome.
Okay, and I guess some people might be saying, but last year's dividend was big. How big was last year's dividend, adding in franking credits, the whole bit?
I thought it was grossed up 11%. I think that's the number that's in my mind, Peter. It is moving around. So I mean, it has, I mean, the past dividend doesn't move around, but I think it was around 11% grossed up. The share price moves around, so what base you use is a little bit,
I guess some people,
but it was big. It's huge. It was a huge dividend.
And that was, and all of us should send Bill Shorten a Christmas card. But the bottom line also is that this year, what do you think is going to, given all the curveballs have been thrown at us, what do you reckon grossed up it might be this year? And be absolutely 100% accurate too, Shawn. There's a very easy thing to do.
I mean, it's really, I mean, that share price, you just mentioned earlier that, the Switzer share price has gone from 166, I remember that number, to, it was around, 266 at the start of the year. I mean, that's enormous volatility there. What number do you use as a base? And this year, I think will be okay. I am, as we mentioned earlier, I'm a bit nervous about what's going to happen and in August, but we like to get 6% grossed up. I think we'll hit that number this year on a share price which is higher than what it is now.
Okay, so that's a reasonable, and basically that's what we've always tried to do. All right, so our future dividends like to return to earlier levels, and if so, when? So I guess the bottom line, earlier levels wasn't last year's levels, kind of around what we're predicting is around.
Yeah, I mean, they certainly won't return to the last financial year, right?
Yeah,
I forget that was a one-off. But look, I think, sort of 6% grossed up, which is about just over 4% in cash terms, is about probably achievable.
Yeah.
I mean, the question with dividend yields, of course, it's relative to the share price, right?
What's your board?
And so, when the market's down, you get the same dividend, you actually get a higher yield. When the market is up higher and you get the same dividend, it's a lower yield. So you've got to be a little bit careful here. A bit of mathematics comes in the way, but that's my opinion. I mean, I think why Shawn's a bit more concerned about next year is that the dividends this year, the impact of the virus will be felt in essentially, take the banks, for example, right? The three major banks, or three other banks, Westpac, National Australia Bank, and ANZ, their half year ends today, right? So the dividends,
they're good.
They're going to be okay still, because the impact of the virus is going to be very little on the last 6 months. They'll see a little bit of, expenses this month, and they'll be probably a little bit nervous about, provisions, but they've only got really, 5 or 6 weeks of the virus impacting things. And that dividend's going to will be announced in May and paid in June and July. But you roll that over 6 months, when they've got a whole 6 months of the virus, that dividend possibly going to be affected. So I think that's why Shawn says it's probably less impact this year than next financial year. Do you want to comment on that, Shawn?
Yeah, exactly right, Paul. Exactly what you said. I think that this happened so quickly that the companies have had several months of good performance in there, but when we start to get the full period, it will be basically from now till when, till September, so next 6 months, and that will be, so the next couple of dividends will be the ones impacted, I suspect, and then hopefully back to normal levels.
Yeah, and I guess in the most optimistic world, we got a really tough economy in the June and September quarters, and the December quarter could be the rollback one, because you've got basically all that stimulation in the pipeline. If the virus numbers improve faster than was expected a couple of weeks ago, well, that could be a very good thing for the last quarter of the year. So we'll keep our fingers crossed on that, and of course we'll be monitoring that, and that could actually reduce the amount of dividend reduction if that last quarter is better than expected. Do you see this future dividends like return? Have we covered that? Why have the last three, at least, dividends been of such low levels? Shawn?
I think that, hopefully they're not of low levels. I think that's, we're aiming at 4% net, in your pocket before franking. I think they're running at those levels. They are lumpy. I mean, they, when dividends come, we pay quarterly, and we pay everything we get in goes straight out. I was targeting 4% after fees, pre-franking, so 6% basically after franking. I think that's, on our numbers, that's where it's running.
Look, I think, and also what that question is about is also, let's just recall the Bill Shorten impact ended essentially on the 30th of June last year, right? Because it was all about companies bringing forward the payment of particularly getting franking credits in the hands of shareholders prior to the 30th of June. That ended on the 13th of May or 19th of May, whatever the date was. So we had, exceptional payments of dividends in the March and June quarters, and even the December quarter of 2019. Yeah. And come December quarter 18, March quarter, and June quarter 19, and then that all stopped.
Yeah, September, December, and March.
Which are the last three,
disappointing.
Which have been, well, not I say disappointing, but lower than they were on a corresponding basis.
According to this question, they're disappointing.
Yeah. Well, here's the question.
Okay, but I think it's a good explanation, guys, and thanks for that. Now, whilst accepting it is primarily dividend producing fund, in times like this, do you buy and sell deliberately using your expertise to produce income? That's you, Shawn.
We're not a trading fund. We're an investing fund. I think that where we do usually like to try and get profits for the year out of realised profits. What's happened with the 30 or 40% fall in the market, I think that's this year that's going to be a bit of a challenge. I suspect, I haven't looked at the numbers. They were looking good up until March. I'm not sure how we'll go over the next 3 months, but I'll just have to let one go to the Cooper, Peter, just how much we'll get in realised profits this year. The market is down a lot. We do participate in what we see as attractive issues, and I think there's going to be some coming up over the next several months. And where we can get in and buy these shares at cheap prices, we will we'll definitely do that for the fund.
Okay, so we're quite happy to have any other questions sent to us. We're just checking right now to see if there are some questions. I'll put on my glasses so I can read them, and my very valuable assistant is going through the technology. So while we're waiting for technology to deliver the marvels of the modern age, Shawn, going forward, is it likely that you will sell some companies because even though this company might have a reasonable outlook, other ones might have a much better outlook? Or if you got the fear that maybe the dividend would be cut too much, you might vacate them and camp into different stocks that are more likely to paying better dividends?
Yeah, that's a really interesting question, Peter. How to play this, the longer term recovery. I think that the market in the first move is, I suppose there's still people going to cash now. So it's the next first move will be from cash to into shares. That's not really our decision. Is really shares into other shares. but when people buy those shares in their first instance, I suspect they go for the most, they'll go for Woolies, Coles, Telstra, BHP, maybe Commonwealth Bank, etc., etc. And then as the rally and the economy starts to improve, you start to move out towards a more riskier company. So you just like move towards those, and I suspect that's the way it's going to play out. So we're not buying those companies where we think they're going to struggle to pay their dividend between now and at the end of the year. At the moment, we're the last stocks, to give you an idea, we bought for the fund with BHP, CSL, and Evolution Mining, a gold company. So fairly defensive. I think that as you play this as we improve, you start to open your shoulders up a bit more, and move out there. But we're not moving out on the risky area of the stocks at this point. We'll stay fairly close to the conservative companies that we don't think will need financing and also can pay a dividend.
Okay, here's a question from Bob. How will the process of eventual repayment of the huge government debt impact on the share market? Well, Bob, let me just take that as an economist. The bottom line is the budget deficit will get big, the debt will be big, they will pay it back over time. The bottom line is that interest rates are so low now, in the first few years, it's going to be very easy to pay that back. I don't think there will be a negative implication for the stock market. But I guess over time, if because of all the stimulus, in the end, we actually see inflation coming back and interest rates rising, there could actually be a problem. But if interest rates are going to rise, that could be a trigger for the stock market to fall again. But my personal feeling is the stock market's going to lap up the fact that this is going to create growth that wasn't expected. So I wouldn't be worrying about the stock market, having problems with this debt payment for some time. Paul, you agree?
I think so, Peter. I think this is an issue for the market years down the track. They eventually will worry about it, but I don't think that's in anyone's mind today.
Okay, I'll save that question, Shawn, because Paul and I are absolutely right on this one. How will the government attack SMSFs to help pay off the government debt? Well, I bet you one thing they won't do is attack franking credits, because they know that really was bad for the Labor Party.
Look, I'm not sure there's going to be any more attack on SMSFs. I mean, all governments, I guess, over time have been making super tighter mainly because the lobby groups from ACOS and others sort of make super sound like a concession, and it is a concession, but because it's designed to actually make you want to save as opposed to spend. I don't think there's further attacks coming, but I keep saying to our clients here at Switzer that the most likely attack, if there is to be one, is to look at account balances. And so if you're, I keep suggesting to people a long-term strategy is, and if you have a spouse, to do what you can to make sure the account balances are roughly the same with your spouse. I think that's probably the best defensive strategy. I don't think there's any, I don't think we're going to see an attack from this government the next couple of years. Peter.
So you're saying that maybe the 1.6 could be brought down to 1.
No, I don't. I don't think they're going to bring it down, Peter. But I think that's one reason why you want to have even out balances. And if they are to do anything, tax it differently. It'll be more on account balance. So there's more reason if you are. As a defence strategy, is just to make sure those balances between, if they are out of kilter, and you do trust your partner.
Of course you do.
Of course you do. That's one thing you should look at.
Okay, Shawn, this is for you. Where can we see what various company stocks make up our Switz shares?
I think we publish, I think it's quarterly, we publish in arrears what each listed ETF has to list their companies, and I'm just trying to think whether that's an ASX announcement or not. I think if you dig through the website, it'll be there. It'll be there. It is done in arrears. I think it's done quarterly. And what you'll see there, I think we publish the top 10 every month. So you can see that there, as I said, it's a list of what we think are the best, strongest companies in Australia. And we think that they will come through. Whatever happens, if corporate Australia survives, these companies are going to survive.
Yeah, if you go to Switzer Asset Management or just Google Switzer Dividend Growth Fund, you can see on the website the top 10.
Yeah.
And I think the full list is published quarterly. I think that's right.
On the Switzer website, Switzer Dividend Growth Fund, or on the Contango website?
No. It's on the Switzer Asset Management.com.au.
Okay.
Yep.
Okay. So switzerassetmanagement.com.au each quarter. Okay, good.
There's certainly an ASX announcement. I just don't know whether it's right there at the moment. So.
Okay. All right. So next question is, how is share price versus NTA tracking? Shawn?
I think that there's volatility. I suspect that question is about the day-to-day share price and the NTA. I think that it is, this volatility is moves around a bit, but basically the market making is performed extremely well over this period, and the bid and the ask spread are basically tracking the NTA up and down. I mean, sometimes the volatility is like the end of day yesterday, we saw a massive increase. We saw that come through in the NTA and the share price today. So I think it's actually done well.
Yeah,
there's no big discount to NTA on Switz. There's no discount on NTA to Switz.
Yeah. So what you basically said before the presentation today was we were up 2%, but the portfolio's value was actually up 6%, but it's caught up today.
That's right, yeah. So sometimes you get that day or a couple of hours, or maybe overnight, and then it's back in line again. So that's it's just a accounting thing, I think. But there's no discount to NTA for listed. There shouldn't be for listed ETF, and there certainly isn't one for Switzer because it's liquid.
Some people might be interested, Paul. Who is our market maker?
Well, we have our market making agent is Macquarie.
Yeah.
And
so it's not a plonker organisation.
No, it's not a plonker.
It's what you might call a pretty good organisation, and I think that's important. If your market maker is strong, that's going to be an important issue that people should be aware of. Another question. Hi guys, thanks for a good presentation. This is a very nice person. Being a current shareholder of the fund, will the fund complete an internal capital raising for its shareholders to increase the cash position in the fund and participate in sound investment opportunities? Tony from Adelaide.
Look, maybe I can answer that, Shawn. It's actually, because it's actually a unit trust, it can't actually do a capital raising per se, and there aren't shares. You actually own units. So there's some structural issues as to what the ASX will allow us to do and not do. So I think the manager's looking at sort of other ways that this can be done. Shawn, is that your understanding?
Yeah, this is an open-ended ETF. So we see every day we get the inflows and outflows. They go directly into the fund's bank account. So if someone wants to put $100,000 in the fund, as soon as that clears, it's in the fund's bank account, and we see it come in the same as outflows. So the cash balance moves around with those inflows and outflows, and we also manage that cash balance. As I said, it's about 3 or 4% at the moment. So we can see how people have reacted to this downturn, and they've actually held pretty well there. It wasn't like hardly any panic selling at all in the Switz investors. So that's good to see. I think that's a great mark to them, positive mark to them.
I think the historical experience has been that when the market falls, we get more inflows into Switz, and when the market goes up, people take a little bit of profit taking. So people are right. It surprises people. Very rational. In fact, the retail investors are misnomer of sometimes sort of being quite talked in disparaging terms by the press, but all my behaviour over the year, it's institutions who are the ones who panic. Retail is generally a lot more sophisticated in the way they approach these.
And I think smart dividend investors realise that when the market gets really scared, ridiculously scared, there's a good buying opportunity. Here's an interesting question. This person is, and maybe it's a question for you, Shawn. Could you give your opinion on MQG, Macquarie, at the current price, please? Have you thought to yourself, gee, these guys are looking like good value?
Yeah, always dangerous to give stock individual stock calls, but I'd say we're a holder of the fund. We have a decent position in Macquarie Bank, and I'd say that is one of those blue chip stocks that you'd have to look closely at in this pullback. It's around that $70 or $80 level, given any type of reasonable long-term outcome, is in my view attractive.
Yeah, I must admit, I looked at FN Arena to see what the analysts were saying about Macquarie last night. I think they had a 35% rise on it, which doesn't surprise me considering where it was. Look, they all want stock questions now.
Well, maybe it's time to ring the webinar. We can't do too many stock quizzes. This is the webinar on Switch.
Yeah. What stock is likely in the buy zone? Everyone that's in our fund, I guess you could say. Yep. What else we got there? Hope the debt is repaid by increasing the GSC. That's always a possibility, but no government will get it through. Switch currently an attractive buy versus other companies. What is the percentage of your own portfolio do you have invested in Switch? And also, what investments do you use for international investment like Switch Fund? Well, I have a pretty significant holding in Switch. Probably 10% of my self-managed super fund, I'd say.
Yeah, mine's about that magnitude.
Yeah. I'd like to hold more, but I'm actually restricted.
We are. So we've got to declare that. So yeah, that's about the other internationally. I look at WQG. I'm also director of that. So that's the WCM people. Yeah. I think that's a fantastic.
Which is related to us, but they've actually performed. And we recommend Magellan to our clients here, but we also recommend WCM because they've actually outperformed Magellan on 10, 5, 3, 2, I think 1 year basis. Yeah. So they're both very good funds, but Paul's right. WCM is a very good fund. Yeah. Okay. Well, guys, it looks like we are out of time. My very valuable assistant just gave me the Maori line across the neck, means cut it, which they did a Harker once, didn't they? Got in a lot of trouble for that. So you're in trouble as well, my assistant. But that's the show. Thanks for joining us. I hope we've actually helped you understand what's going on and what our feeling is about the Switzer Dividend Growth Fund. Thanks for being supporters. And if you've got any other questions, make sure you email them to Tom Hickey at Contango. Give him as much hard work as possible. Thanks very much for joining us.
Thank you.
Thank you.